What I'm about to explain may completely change how you see money, security, and wealth. Right now, millions of people believe they are being responsible by holding large amounts of cash. They feel safe seeing numbers sit still in a bank account, untouched by market swings. But that sense of safety is an illusion. We are entering a financial era where doing nothing is not neutral. It is destructive. The economic environment ahead will quietly punish people who avoid movement and reward those who understand how money actually behaves over time. Cash feels stable because its number doesn't change, but its value does. Every year, inflation reduces what your money can buy. Food, fuel, housing, healthcare, education, everything steadily becomes more expensive. When your cash earns less than inflation, you are losing purchasing power without realizing it. The loss doesn't feel dramatic. It happens silently, slowly, and relentlessly. That is what makes it so dangerous. Many people justify holding cash by calling themselves cautious. They say they are waiting for the right moment or preparing for uncertainty. In reality, uncertainty is always present. There is never a perfect time. History shows that people who wait for absolute clarity usually miss the opportunity entirely. Holding cash is not risk-free. It is simply a guaranteed slow loss, disguised as safety. Modern monetary systems are designed in a way that discourages saving in pure cash form. Governments expand money supply. Central banks manage interest rates, and inflation becomes a structural feature of the lack economy. In this system, cash is a temporary tool, not a long-term store of value. Treating it as wealth is a fundamental misunderstanding. This doesn't mean reckless investing or ignoring risk. It means understanding that money must work to survive. Wealth is not built by standing still, built by positioning yourself in assets that can adapt, generate income, and grow alongside economic change. Those who fail to grasp this reality will look back years from now and wonder why the money didn't go as far as it once did. To understand why cash is quietly damaging your financial future, you need to understand purchasing power. Purchasing power measures what your money can actually buy, not what the balance says on a screen. When inflation rises faster than your returns, your money shrinks in real terms. Even modest inflation compounds into massive losses over time. Imagine holding a large sum of cash for 10 years while inflation averages 5%. That money loses nearly half its real value. You didn't spend it, you didn't invest it, yet it disappeared anyway. That is the cost of inactivity. It's not visible, but it's very real. People often argue that cash gives flexibility. They want to be ready when opportunity arrives. But opportunity doesn't require hoarding excessive cash. It requires liquidity, not paralysis. Liquidity means having access to funds when needed, not letting all capital sit idle indefinitely. There is a crucial difference between preparedness and stagnation. Wealthy individuals understand this distinction clearly. They keep enough liquidity for emergencies and opportunities, but the majority of their capital lives in productive assets. They allow their money to move, earn, and compound. Over time, this compounding effect becomes more powerful than any single investment decision. Another hidden cost of holding cash is emotional comfort. Comfort can be expensive. When people feel too comfortable, they stop learning, analyzing, and adjusting. Markets evolve. Economies change. Those who remain static fall behind. Cash gives the illusion of control, but real control comes from understanding systems and positioning yourself wisely within them. It's uncomfortable but simple. Money that does nothing is money that decays. If your strategy relies on waiting indefinitely, you are not protecting wealth. You are slowly surrendering it. The opposite of idle cash is income-producing assets. These are assets that generate cash flow while you own them. Dividend-paying stocks, bonds, real estate, and income funds all serve this purpose. They don't rely solely on price appreciation. They pay you for ownership. Dividend stocks represent ownership in real businesses that generate profits. When these businesses are stable, established, and well managed, they distribute part of their earnings to shareholders. Regularly, this income can be reinvested, creating compounding growth or used as cash flow. Over time, dividend growth often outpaces inflation, preserving purchasing power. Bonds play a different but equally important role. They provide predictable income and stability. When interest rates rise, new bonds offer higher yields. When rates fall, existing bonds gain value. Bonds help balance volatility and ensure steady income, especially during uncertain markets. They are not exciting, but they are effective. Real estate, whether owned directly or through investment trusts, adds another layer of protection. Property generates rental income and often appreciates alongside inflation. It benefits from long-term demand, population growth, and limited supply. Even when markets fluctuate, people still need places to live, work, and store goods. The strength of income-producing assets lies in diversification. Each asset responds differently to economic conditions. Together, they create resilience. Instead of betting on a single outcome, you prepare for multiple scenarios. This is how wealth survives inflation, recessions, and market cycles. Cash alone cannot do this. It produces nothing, it adapts to nothing, it simply waits, and waiting is expensive. People avoid investing because they fear making the wrong move at the wrong time. They worry about market crashes, interest rate changes, or economic slowdowns. These concerns are natural, but they lead to the wrong conclusion. The solution is not timing the market. The solution is diversification. Diversification spreads risk across assets, sectors, and income sources. It acknowledges that no one can predict the future with certainty. Instead of guessing, you build a structure that can function under different conditions. When one area struggles, another often stabilizes or grows. A diversified portfolio might include dividend stocks for growth and income, bonds for stability, real estate for inflation protection, and a small amount of cash for flexibility. The exact mix depends on personal circumstances, but the principle remains the same. You don't rely on a single outcome. Time is more important than timing. Markets move in cycles, but over long periods, productive assets tend to grow. Those who stay invested, reinvest income, and remain disciplined benefit from compounding. Those who wait for perfection rarely act at all. Fear often disguises itself as prudence. People convince themselves they are being careful when they are actually avoiding responsibility. Managing money requires decisions. Avoiding decisions is itself a decision with consequences. The most successful investors are not fearless. They are informed. They understand risk and manage it through structure, not hesitation. At some point, knowledge must turn into action. Understanding the problem without responding to it changes nothing. If you hold excessive cash today, the solution is not to eliminate it overnight. The solution is to deploy it thoughtfully, gradually, and intentionally. Start by evaluating how much liquidity you truly need. Emergency funds serve a purpose. Beyond that, excess cash should be working. Begin with simple, understandable investments on income, quality, and diversification. Complexity is not required to build wealth. Consistency is. Every delay has a cost. Every month spent waiting is a month of lost compounding. Over years, those lost months become lost opportunities and eventually lost decades. The future does not reward hesitation. The financial environment ahead will favor those who adapt. Inflation, policy changes, and economic shifts are not temporary problems. They are structural realities. Wealth will move from those who misunderstand money to those who respect how it works. You don't need perfect conditions to start. You need clarity and commitment. Cash is a tool, not a destination. Assets are the engine. If you want your money to survive and grow, it must be allowed to work. The choice is simple but not easy. Stay comfortable and watch purchasing power fade, or take informed action and build resilience. The sooner you decide, the more powerful the result will be.